Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Wednesday, February 18th, 2026, and we've got a packed show for you, diving into the market data from yesterday, February 17th.
That's right, Ethan. Our AI systems have been buzzing, flagging quite a number of stocks with significant social media activity yesterday. We saw a really interesting mix, from established tech behemoths to some highly speculative plays. Overall, I'd say the market commentary is cautiously optimistic in some areas, but certainly highlights some deep-seated risks in others.
Absolutely. A lot of different tickers got people talking. Let's not waste any time and get right into some of these insights. All right, first up today, we're looking at Strategy Inc., MSTR. Now, our systems flagged a lot of user discussion around this one, with some really strong bullish sentiment, despite an initially bearish post. It seems a lot of users are taking a contrarian view, suggesting that if the original poster is bearish, the actual play might be calls, inverse WSB as they say. Some even see a short-term pump potential, and we've even seen news about institutional endorsements, like Charles Schwab increasing their stake.
Well, Ethan, while that speculative optimism is definitely present, the KPIs for MSTR tell a very different story. This stock has consistently been a stay away for us in previous ratings, and that's not changing today. We're looking at an incredibly high debt-to-equity ratio of over 16, which is just staggering. The company is deeply unprofitable with negative EPS and an operating margin deep in the red. And let's not forget that beta of 3.5, extremely volatile. While users might be looking for a quick flip, the fundamentals here are just too risky for me. It's also highly tied to Bitcoin's performance, which has seen some struggles breaking past $70,000 recently.
Fair points, Brooke. So for MSTR, Strategy Inc., we're classifying it as a stay away. Next up, SanDisk Corporation, SNDK. This one's interesting, with a major shareholder, Western Digital, divesting shares after massive gains. But on the flip side, we're seeing news about the NAND shortage and strong growth in AI-linked SSDs, which could really boost demand for SanDisk's products. There's also been some net insider buying recently, which is always a good sign of internal confidence.
I appreciate the optimism, Ethan, but the sentiment we saw from users was a straight-up bag-holding complaint. And when we look at the KPIs, it's a real concern. This company is currently unprofitable with negative net profit margins and EPS. That's a downgrade from some previous buy ratings we've given it. Plus, the debt-to-equity ratio is almost 8, which is still incredibly high. While AI-linked SSDs are a strong tailwind for the industry, without a clear path to profitability and with such high debt, the risk here is just too high. The large secondary offering also suggests that some sophisticated investors believe the big gains are behind it.
All right, so for SNDK, SanDisk Corporation, that's a stay away. Moving on to a true giant, Amazon.com, AMZN. The discussion here centered around hard drive shortages pushing more companies to cloud storage, and Amazon Web Services, or AWS, is a dominant player. Even if the user's technical premise was debated, the core idea of increasing cloud demand is certainly plausible. We've seen news about Soros doubling down on big tech, and Amazon is actively working on an AI content marketplace. Plus, we've got significant insider buying here, over 1.5 million net shares purchased. That's a huge vote of confidence. This would be an upgrade from some of our recent stay-away classifications.
I do agree, Ethan, that the insider buying is a powerful signal, and Amazon's revenue growth of nearly 14% and a healthy 10% net profit margin are very strong. While the PE and PB ratios are high, reflecting growth expectations, the current price is actually below its 52-week high, suggesting a potentially attractive entry point. The fundamental argument about cloud demand for AI is robust, even if the user's explanation was a bit colorful. Given the strong financial performance and insider conviction, the long-term potential here looks promising.
So AMZN, Amazon.com Inc., is a definite buy for us today. Now for Simpson Manufacturing Company Inc., SSD. The user discussion we analyzed was primarily focused on data storage, which actually isn't this company. However, looking at the news directly related to SSD, Stevens recently lifted their target price, citing operational resilience, and there's been significant insider buying, over 9% of total insider shares purchased. That tells me there's internal confidence.
That's an important clarification, Ethan. The user discussion definitely wasn't about Simpson Manufacturing. And while the insider buying is a positive signal, we can't ignore the KPIs. SSD has an extremely high debt-to-equity ratio of over 23. That's a red flag for financial risk, regardless of operational resilience. Plus, its PE of 25 is quite high for a company with moderate revenue growth of 4.2%, and the beta is over 1.3, indicating higher volatility. Stevens' price target is also below the current trading price. Too much risk for the potential reward, in my opinion.
Understood. So SSD, Simpson Manufacturing Company, Inc., is a stay away from us. Next, let's talk about Microsoft Corporation, MSFT. Our data showed some users expressing frustration over recent losses, but there's a really strong underlying long-term bullish conviction, with many calling it a blue-chip stock currently at a discount. People are advising patience, expecting a bounce after the next earnings call. When you look at its revenue growth of nearly 17% and that phenomenal net profit margin of almost 40%, it's hard to argue with the quality here. Plus, insider buying is strong, with over 400,000 net shares purchased. This solidifies its buy rating from us.
I agree, Ethan. Despite the short-term user frustration and some recent negative headlines, Microsoft's fundamentals are incredibly robust. That near 40% net profit margin and low debt-to-equity ratio of around 31 means it's financially sound and efficient. This company generates a ton of cash and isn't relying on heavy borrowing. The current dip from its 52-week high, as users pointed out, could indeed be seen as a buying opportunity given its strong growth trajectory, especially with ongoing advancements in AI and cloud.
So MSFT, Microsoft Corporation, is another buy on our list today. Now for Micron Technology Inc., MU. One user shared a $2,600 profit on a short-term trade, but the real story here is the overwhelming news about the AI memory crunch driving massive demand. We're talking about billions in AI memory expansion, analysts rating price targets, and reports of gross margins targeting 68%. Plus, insider buying is huge here, over 29% of total insider shares purchased. Ethan, the AI narrative for Micron is undeniably strong, and the potential for increased revenue and expanding margins is significant. That insider buying is a powerful signal. We do need to acknowledge the relatively high PE ratio of over 38 and a debt-to-equity ratio of over 21. While the AI boom could certainly help improve profitability and debt metrics in the long term, these are current risks. But if those projected gross margins materialize and demand continues, the current KPIs could see a significant positive shift. Given the strong tailwinds, MU, Micron Technology Inc., definitely earns a buy from us today.
And finally, Carvana Co., CVNA. The primary post here highlighted a significant options loss, with discussions mostly around wash sales. While the company is showing rapid unit growth, there wasn't a lot of bullish sentiment from the user discussions themselves.
And for good reason, Ethan. Carvana's KPIs are flashing bright red. We're talking an astronomical debt-to-equity ratio of over 192. That's just immense financial risk. Compounding that, insiders have been massive net sellers, dumping almost 20% of their total holdings. And the valuation is sky high, with a PE of nearly 80, for a company with a relatively slim net profit margin of just 3.4%. While unit growth is positive, it needs to translate into sustainable, profitable growth and a drastic reduction in that debt. Given these risks, this remains a stay away, consistent with many of our prior analyses. So CVNA, Carvana Co., is a clear stay away. So to quickly recap our AI-generated market commentary and speculative analysis from today's data, Investigate as buy, Amazon.com Inc., AMZN, Microsoft Corporation, MSFT, Micron Technology Inc., MUN. Investigate as cautious buy, none. Investigate as speculative gamble, Strategy Inc., MSTR.
That wraps up another deep dive into the market. Thank you for joining us on the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. We'll catch you next time for more insight.